The average American inherits about $177,000 from their family. If you're LGBTQ plus and watching this, you probably already know that that number has nothing to do with you. Maybe your family cut you off financially when you came out. Maybe you were never included in the estate plan. Maybe you're starting over at 35 or 40 after finally living as yourself, and the idea of generational wealth feels like something that happens to other people. I get it. I really do. But here's what nobody in mainstream finance is going to tell you. You don't need an inheritance to build generational wealth. You need a plan. And today I'm going to hand you one. I'm going to show you the exact 3 ETFs, just 3, that can take you from zero to building your own family wealth, whether that family is biological, chosen, or just you. And I'll show you the exact percentages to use, how to buy them for free, and the one mistake that could quietly cost you tens of thousands of dollars if you get it wrong. Now, before we get into the portfolio, I need you to understand 3 things. First, why most investing advice is literally built for people who already have money, and what that means for your strategy if you're starting from scratch. Second, the specific allocation that a queer investor starting from zero should actually be using, because it's probably not what the finance bros on YouTube are telling you. And third, the one quiet tax advantage almost nobody talks about that could save you thousands, especially if you're building wealth without spousal or family support. So if you're watching this and you've ever felt like the investing world wasn't built with you in mind, stay with me, because this video was made for you. So let me give you some context, because this matters. There's this thing called the generational wealth gap, and for LGBTQ plus people, it's real and it's massive. According to a TD Ameritrade survey, the average straight household earns about $79,000 a year. The average LGBTQ plus household, it's about $66,000. That's a $13,000 gap before we even talk about investing. But income is just the start. Queer people face higher healthcare costs, are 20 percentage points less likely to own a home, and here's the one that really gets me. Many of us are excluded from family inheritances. We're talking about being written out of wills, cut off from college funds, kicked out of houses. One study found LGBTQ plus young people carry an average of $16,000 more in student loan debt than their straight peers. Not because they went to fancier schools, but because their parents stopped paying. And look, I'm not telling you this to make you feel bad. I'm telling you this because the mainstream finance world acts like everyone starts from the same place. They assume that someone taught you about a Roth IRA at the dinner table, and they assume that you have a safety net. A lot of us, we are the safety net for ourselves and for our chosen families. So when I say 3 ETF portfolio, I'm not just talking about a cute little investment strategy. I'm talking about building your own inheritance from scratch on your terms and making it so simple that you never have to feel confused or behind again. Let's get into it. Okay, so the first thing that most people get wrong when they start investing, they try to pick individual stocks. They hear about Tesla or Nvidia or whatever's trending on TikTok, and they throw all their money at it, hoping it goes up. And honestly, when you're starting from zero, you cannot afford to gamble. You don't have a family safety net catching you if it tanks. Every dollar you invest is a dollar you earned, protected, and chose to put to work. So it better be working hard, which is exactly why ETF number 1 is VTI. When you buy one share of VTI, you're buying a tiny piece of basically every publicly traded company in America. We're talking over 3,600 companies. Apple, Google, the local bank, the random company that makes bolts on your IKEA furniture, all of it. The expense ratio, 0.03%. That means for every $10,000 you invest, you're paying $3 a year in fees. $3. And here's why that matters for us specifically. When you don't have generational wealth, you need the broadest, cheapest exposure to the market possible. You're not trying to get lucky. You're trying to own the whole economy and let time do the heavy lifting. Think of VTI as your wealth engine. This is the fund that's going to get you the most growing over the next 10, 20, 30 years. ETF number 2, VXUS. Here's the blind spot. VTI only covers the United States. And I know the US market has crushed it over the last decade. So a lot of people say, why bother investing internationally? But here's the thing nobody tells you. The US hasn't always been the winner. In the 2000s, international stocks outperformed US stocks for nearly a decade. Markets rotate, and if you're building wealth from zero and have no backup plan, you cannot afford to bet everything on one country's economy, even if that country is America. We already know what it's like to put all of our eggs in one basket and have it dropped. We're not doing that with our money. VXUS gives you exposure to over 8,500 companies across Europe, Asia, Latin America, and emerging markets. Companies like Toyota, Nestle, Samsung, TSMC, massive global players. The expense ratio is still tiny at 0.05%. And here's a bonus a lot of beginners miss. VXUS has a higher dividend yield than VTI, around 3% compared to about 1%. So while your US stocks are growing, your international stocks are also paying you a little cash along the way. And I want to point out something that is specific to our community. A lot of LGBTQ plus people think about relocation to safer states, to friendlier countries. Having international diversification isn't just a smart financial move, it's peace of mind. Your wealth isn't chained to one country's politics. ETF number 3, BND. Okay, real talk. The stock market is going to crash at some point. Not if, when. It happens every few years. And here's what usually goes wrong for beginner investors. The market drops 20 or 30% and they panic. They sell everything and they lock in their losses. Game over. And when you're investing without a safety net, no parents to call, no trust fund to fall back on, that panic hits different. I know, I have been there. So you need something in your portfolio that doesn't crash when stocks crash. Something that keeps your portfolio stable enough that you can sleep at night and not sell at the worst possible time. That's BND. BND holds over 11,000 bonds, mostly US government and high-quality corporate bonds. When stocks are panicking, bonds tend to hold steady or even go up. It's your portfolio's shock absorber. Is it going to make you rich? No. That's not its job. Its job is to keep you in the game. Because the number one thing that destroys wealth isn't a bad stock pick. It's panic selling during a crash. BND stops that from happening. And here's why this is especially important for us. When you don't have generational wealth, you likely don't have a financial cushion outside of your portfolio. BND becomes your built-in cushion. It's the thing that lets you say, the market dropped 25%. Cool, my bonds are fine. I am not selling anything. All right, so here's the million-dollar question. How much of each? If you're in your 20s or 30s and you're building from zero, here's the allocation I'd look at. 60% in VTI, your US growth engine. 25% in VXUS, your global diversifier. 15% in BND, your shock absorber. Now, if you're 40 or older or rebuilding, you might shift that to something like 50% VTI, 20% VXUS, and 30% BND. More bonds, more stability, because your timeline is a little shorter and you need to protect what you're building. And here's the beautiful part. The total blended expense ratio for this entire portfolio is around 0.04%. You're paying virtually nothing. Compare that to a financial advisor who charges 1%. That difference can cost you hundreds of thousands of dollars over a lifetime. Let me say that again. This 3-fund portfolio costs you about $4 per year for every $10,000 invested. You literally spend more on coffee in a week. Remember when I said there was a tax advantage nobody talks about? Here it is. If you're investing without a spouse or without family financial support, you are likely filing as a single filer. And single filers can contribute to a Roth IRA as long as their income is under the limit, which in 2026 covers the vast majority of people. Here's why it matters. If you put these 3 ETFs inside a Roth IRA, every single dollar of growth is tax-free. Not tax-deferred, tax-free. When you pull that money out in retirement, you owe nothing. And here's the part that's specific to our community. A lot of LGBTQ plus people are navigating retirement alone or with a partner but without the spousal benefits that married straight couples have historically had access to for decades. Building a Roth IRA means you're creating a pool of tax-free money that you can control completely. No employer can take it away. No policy change can touch it. It's yours. And quick bonus tip, put VXUS in your taxable account if you have one, because you can claim that the foreign tax credit on those international dividends. Free money from the IRS. They don't give those out often, so take it. Okay, I don't want you to watch this and then do nothing. So here's your action plan. 5 steps, 10 minutes. Step 1, open a brokerage account. Fidelity, Schwab, or Vanguard, they all work. All 3 score high on the HRC Corporate Equality Index, which matters. It's free. Takes about 5 minutes. Step 2, start with whatever you have. $50, $100. You can buy fractional shares of all 3 ETFs, so there's no minimum to get started. Step 3, set your allocation. If you're young and you're building from zero, 60% VTI, 25% VXUS, 15% BND. If you're 40 plus and rebuilding, 50 VTI, 20 VXUS, 30 BND. Step 4, automate it. Set up automatic investments every payday. Even $25 every 2 weeks adds up to over $15,000 in 10 years at average market returns. Step 5, rebalance once a year. Just check your percentages and adjust. That's it. That's the whole plan. 3 funds, 10 minutes to set up, and you've just built the foundation of your own generational wealth. No inheritance required. Now, this 3-fund portfolio is powerful, but once you've built it, the next question is, can these investments actually replace your paycheck? Like, can you get to the point where your portfolio pays your bills every single month? That's exactly what I break down right here. 2 ETFs that could literally replace your paycheck, starting with as little as $10 a day. It picks up right where this video leaves off and shows you how to turn this foundation into income you can live on. Click right here and I'll see you there.